Hey, thanks for being here. As always, good to see everybody. All right, let's dive in. 2023 year of the rabbit. I like this because it's personal to me. I was born the year of the rabbit, so I kind of feel like it's my year. It's time to have a good time. The thing I like about the rabbits, they're quick and nimble, able to get out of the way of danger very quickly and be that kind of thinking. On that note, we had a good February, largely up with the indexes, both stock and bonds being down about 2.5%, which was awesome. And I'll go into a couple things, what we did and why that worked out. And then going forward, the recession is still out there. So we need to be quick to be protective and really market neutral, I think, is the way to go on that. And that's really why we had a good February. As of right this very second, our positioning in that is long the NASDAQ and short the S&P, right? So what we want is the NASDAQ to go up or go less than the NASDAQ is going down. And as of right now, the S&P is down 0.2%. and the NASDAQ is up 0.1%. So market neutral is actually making 0.3%. It makes the difference between those things. And I think not a lot of people fully understand how that works because earlier this week, the markets were down, 1.5%, 2%, but S&P was down more than the NASDAQ, and we actually made money on that. And that was awesome. That's why I love the market neutral thinking, and we're being quicker to add that than we had been last year, as well as doing it more than we were last year, because that was really not a tool we had in the toolbox first quarter when things got really crazy when the beginning of this all happened. And since the summer, we've been using it more and more very effectively. And I'm very happy with how that's working. So let's get into the data. Long term, we kind of peaked right at the last webinar. I think it was right around there. And then it's just kind of been down sideways since. Long term, just kind of saying that the money's flowing into the market, just not real strong anymore. It's just kind of fading, but it's still there. You don't want to bet against it too much just yet. We're still in a good spot. The midterm cycle, this turned negative on the day of our last webinar. I thought that was awesome. And what has the market done since then? Not a whole lot. It's been a lot of down. And again, we've been doing more of the neutral situation. So that's really kind of kept us safe. I'll show you a couple of charts of how things happened since then. But yeah, money flow is still negative. It's trying to improve. It's just not there yet. You'll see in the rotation charts that everything is in the red box, but I think we should be coming out of this soon, and we should see a run up into the end of the month, early next month. I'm not sure what the time frame is on it yet, but it seems to be in the near future. All right, the S&P. Last time it was right there, right at the peak, right? And then last time we said, well, we kind of expect the market to pull back to about where this line is. And it almost did there. It still could again, with the market being down a little bit today. We could see the next week or so come down to there. And then that would be a great spot for a new rally to go up, 10, 15% on the S&P. Now that'd be temporary, but it'd be a window where we could grab a little bit of upside and then get back to playing it safe like we are now. We're very defensive right now. So we missed a lot of this downside, which was awesome. I'm very happy about how that worked out. Nimble like the rabbit. Sectors +3 to a -8. What is kind of interesting here is we have the social media companies and the communications. Industrials just went positive. And technology, like I was saying, the NASDAQ is the strongest right now. I'm not sure why. It was the weakest for most of last year, but if the data says so, then we're going to go with that. Interestingly, these two over here, basic materials and energy, they're kind of two variations on the same theme. They've both been positive for the past few days, and you'll see in the rotation chart where they're the ones that are peaking soon as well. Also, utilities are positive for one day. So, as we see the shift, these negative sectors should move to the positive sectors, and then we should see the S&P move up with it. But right now, it's just kind of down. We could still have another few days of iffiness, but we're playing defense right now, so I'm not really too concerned about it. Here's the rotation I was talking about. Here's basic materials. Here's energy, both up hitting the blue. They're like, hey, we're going in the right direction. What we want to see is the whole group pushing up into blue and into green, and then the market will run when that's happening. But we still have a little ways to go. Some of these seem very confused. You can see they're still just kind of lost in this red box and they don't know what's going on yet. But there will be a time, as I said, these kind of go like little ducks in a pond going circular around and around and around. That's just how they go. Eventually these will all figure it out, and then they'll go, okay, we need to be going up now. And it'll rotate through this circle. So we'll have a improving, leading, and then you get another time where we'll want to get back out when it's weakening. It could be soon, it could be later, but it's setting up at this point. All right, indexes. Last month, these were all positive, and I think the day after our webinar, it went negative. So this is interesting. So the rotation, where they are, these are the indexes in the box. They're all in the red box still. So we're talking about the tax-exempt bonds, world stock, thinking of international, the S&P is there. The bond market is definitely there. This is a balanced index as well as the high yield. High yield bonds are not doing well. I would really want to see them come up as well, turn green and positive, because if they're positive, then usually the S&P and the market will come with that too. That's the part of the bond market that most reflects the stock market. And when they agree, good things do tend to happen. So we're not there yet, but it's feeling like I showed you underneath. It's all pushing in that direction right now. Okay, this is the slide from the last webinar on the bond market. This is the Vanguard Bond Index market. We said, hey, look, there's an orange bar here. It's turning into the lagging. That's not real positive going forward. We expected the market to go down. You can go watch the video from last month, and I do actually say that. And here's what happened. Here's that orange bar and straight down. Bond index had a bad couple of weeks or even month at this point. Interesting to see it play out in real time. It was fun to get a signal on the day and then see where it went from there. And it does tend to play out as I said it would. It looked like here you had the orange and then a failure. You had orange and then red. But then after every red comes the blue and the green part, right? The improving and then the leading. The improving and then it leads. It improves, it leads. It's a cycle. It always just runs in these circles. So this can run as long as it wants, but at some point it's going to say, hey, we're done. We want to start improving and then leading. And that'll be a great time to be invested in that. But for now, it is not. Because we actually do still own some bond funds right now, but they're usually very, very short duration. The bond index tends to be a little more broad index, broad duration. So it will move quite a bit more than what we own. When you shorten duration, you get volatility, gets squished. So it doesn't really go anywhere and you just get the dividends. That's what I got for this week. Thank you all for being here, and I'll see you next time.